Hello, everyone. Welcome to our monthly podcast series. This month, we have a very special guest joining us to discuss the recent fire rally in the equity market post the first Fed rate cut. I have with me today Tan Jee Toon, Chief Investment Officer, Asia Pacific Equities of RHB Asset Management Singapore. Hi, Jee Toon. Thank you very much for joining us today for our podcast series.
Hi Nova, very happy to be here.
Newton, September was an interesting month where we finally witnessed the beginning of the US Fed rate cut cycle. Within the general market consensus, 50 basis point was cut and sent a few good factor to the ground. Most equity market was up post the rate cut, including the US equity market. However, what surprises us was the follow-through action by the Chinese central bank, unveiling the most aggressive monetary easing policy since pandemic, driving aggressive rebound in the Chinese equity market. Hang Seng Tech up by 34% in the quarter since the interest rate cut. Chinese A50 up by 25% since the rate cut. HSCI up by 22%. Hang Seng Index up by 20%, which was a far cry outperforming the US indices of a low single-digit recovery. Please give our investor a brief roundup what had happened over the last week in China in terms of new policies that had given the market a massive boost.
Sure, Nova. Indeed, over the last few days, I think the Chinese market had a massive melt up, right? Post the rate cut that we saw in the US. I think last week's stimulus cocktail of stronger than anticipated monetary easing, more forceful policymaker directions, and powerful stock market support measures. And on top of that, we have new efforts to put a floor under the property market. All this combination of policies measures definitely was much better than what the market was expecting. And in my opinion, I would like to highlight a few key policies which I think are very significant that were being implemented over the last few days. Firstly, is in terms of monetary policies, like what you mentioned earlier. I think there was a massive cut in reserve requirement ratio, or RRR, for the banks, which will release renminbi 1 trillion liquidity into the financial system. That is definitely a big boost to the market in general. Secondly, there were more obvious support for the property sector. The most significant one was, I guess, the reduction in down payment, and China will lower the minimum down payment to 15% from 25% for second home buyers nationwide. And that will be in line with first homes. And that's definitely a big boost to market sentiment. The other one is a reduction in existing mortgage rates. Banks will reduce interest rates on existing mortgages by 0.5 percentage point on average in order to provide relief to household. And this will save Chinese household roughly renminbi 120 billion per year. Last but not least, in terms of property support, the government have said that they will support commercial banks 100% to finance loans that these banks will offer to state-owned firms for acquiring unsold flats. And that is up from the 60% that we see now. Last but not least, I think some of the biggest measures were in the attempts to revive the Chinese stock market. The more important one is there was a program to allow mutual funds, insurers, and brokers easier access to funding in order to buy stocks directly. And PBoC have also indicated that they will provide cheap loans to commercial banks to help them fund listed companies, share buybacks, and share purchases. Last but not least, right, the government also said that the China State Fund, Central Huijin Investment, will be supported in their purchase of stock across the domestic market, as well as to expand their investment scope. So all in all, these key policy changes that we saw over the course of the last few days definitely provided a big boost to market sentiments over the course of the last weeks.
Jee Toon, when it comes to easing of a monetary policy in terms of interest rate cut or lowering of reserve requirement ratio, is not new. PBoC has been cutting lending rate for at least the past 5 years, while reserve requirement ratio has been cut for up to the last 10 years. What is so special this round that has caused the market to sit up and take notice?
I think these are a very astute observation. But this time around, I think why the markets set up and took notice could be attributed to, I guess, four factors. I think the first one is, I think this time around, all these policies were very, very well coordinated. PBoC, or the People's Bank of China, together with the National Financial Regulatory Administration, as well as CSRC, China Securities Regulatory Commission, all came together in a well-publicized press conference to announce all these measures. And more importantly, 2 days later, Political Bureau led by Xi Jinping came out and emphasized the importance of the economy and also assured Chinese people that they will support the stock market. Secondly, I think the size and the scope is something that we have not seen since the COVID crisis in terms of the amount and the comprehensive scope of support, which ranges from the property to the stock market to SME and all the way to the banks. Thirdly is the approach. It is indeed very, very rare to see policies that directly support the Chinese stock market. And on top of that, we have a cut in mortgage rates in order to spur consumption. Last but not least, like what you mentioned earlier, it was all about timing. I think the timing this time around was great. The reason was because it was done after the US cut their interest rates by 50 bips. And on top of that, we have seen flows moving out from the US to emerging markets, including our parts of the world and China. And on top of that, we have seen currency appreciation across the board, including the renminbi as well. So all this coming together at this precise moment in time when everybody's positioning was very light in China and the pessimism on China was at its all-time high. All this created the perfect conditions for the melt-up that we saw in China over the last few days.
I have a chart here for the past 3 years that shows the Chinese equity market has the strongest quarterly recovery in Q3 since the past 3 years. With such spike in the Chinese equity market, Jee Toon, do you see a risk of the pullback in the market, especially for those investors who are seeking to reduce exposure?
Once again, a very good question. However, I would like to point out that at this point in time, right, before the massive rally that we saw over the last few days, there was not much exposure in China to be reduced. First of all, there was very, very light positioning in China across all global and emerging markets portfolio, because I think China is a consensus underweight across all the global portfolios at this point in time. And secondly, I think retail participation, even amongst the Chinese investors, is very, very weak at this point in time. So in short, there was not much exposure to reduce in the first place before the rally. Second of all, is that the initial part of the rally was due to short covering due to the high level of pessimism that we saw. All the shorts were being covered aggressively in the first few days. And last but not least, we are also starting to see China retail participation starting to pick up now as we speak. The demand for new brokerage account reportedly surged over the 29th September weekend. So all in all, what I'm trying to say is that even with this rally, right, there is not much exposure for investors to cut because they are not highly invested in the Chinese market at this point in time.
This is my last question. Jee Toon, looking forward, what are the potential catalysts that may propel the Chinese equity market higher?
I think there are a few key factors that we can look forward to. One would be the continued interest rate cuts in the US. Continued interest rate cuts in the US will have positive impact on flows into China and Asia. And on top of that, we would have appreciation of the Asian currency, including renminbi. Second, we can look forward to more concrete fiscal policies to be announced in the near future. What we have seen over the last few days are probably more in terms of monetary policies as well as stock market support policies. We have yet to see more concrete fiscal policies that I anticipated will be announced over the course of the next few weeks. And thirdly, we can look forward to the property sector stabilizing. We are expecting new sales to increase over the course of the next few quarters. And on top of that, property prices should start to stabilize or even increase. Last but not least, as a result of this positive sentiment from the stock market and possibly the property sector creeping into consumption and industrial output, we expect both consumption and industrial output to increase over time due to this recent round of stimulus. So these are some of the catalysts that we can look forward to that will drive the Chinese equity market even higher.
Thank you for your sharing today. Appreciate your time for joining us in such a short notice, Jee Toon.
No problem, Nova. Very happy to be here.
Dear investor, I hope Jee Toon sharing today will give you a better insight of what you need to do with your Chinese equity exposure in your portfolio. Please discuss with our RHB Bank's relationship manager for the next course of action on how to rebalance your investment portfolio. Meanwhile, see you again in our next podcast series.